Hey guys, welcome back to another episode of Trade Stock. I'm your host, Justin White, and today I got a special guest in the studio. We have Chris Angelo from Stay Green from Southern California. Chris, welcome to the show, man.
Yeah, Justin, great to see you. It's always great to run into you at industry events. Happy to be on your show.
Here, man. Al, thanks for coming on. You've built an incredible business. In fact, at K&D, we've looked to what you've done and Stay Green as a bit of a North Star of how to build our business out. So what you've done for the industry, the examples you've set, the amount of sharing you've done, whether it's been on stage or just, at the bar after hours at our industry events, it's been super appreciative to learn from you. And I'm excited just to have a conversation today about that growth. So I think a great place to start, because this is such an interesting story, is how did you get involved with the landscape industry from the very beginning? What was that first introduction to landscaping?
Yeah, Justin, that's it's deep. So if I can, I'd like to peel it back another layer to the first generation. We'll go back to my dad,
okay,
and then we'll jump into how I got involved in the landscape business, because it'll set the stage of where we are today. Sound good?
Perfect.
So,
sounds great.
Yeah, so my dad started our business in 1970. And so back in 1970, when you think about the marketplace, there was not a commercial landscape demand. And so my dad was competing against Japanese gardeners in Los Angeles area at the time. And so he was an Italian competing with Japanese gardeners in Los Angeles for residential accounts. And so the commercial space really didn't develop until we had significant freeway expansion in California, and then you started to see general contractors that were installing landscape, but they were really road and paving guys. And so it created a niche for a new subcontractor, such as a commercial landscaper. And so I think that's when kind of like the license was created in Southern California, or California per se, and started to do that work. And so it's pretty neat. So I grew up in a family business doing landscape services. And so our dinner table conversations were all about what happened that day with dad and mom. And so there was an industry called the California Landscape Contractors Association, known as CLCA. And so all of the guys that were getting into the landscape industry joined this state industry association, and then we're part of the chapters. And so we started going on our family trips every summer with the CLCA group. And so I'd meet other guys like you as a kid. I'd probably be 5 years to 15 years of age. We did summer vacations with other landscapers doing the same type of work my dad did. So that's how I got really exposed to the landscape business, really felt a sense of community by seeing other dads and families doing the same thing that we did to earn an income and put food on the table. And so that was my exposure to it. It was really neat.
Wow, what a start to that. So it sounds like your dad was one of the pioneers in the landscape industry in California, with CLCA being such a pivotal part of that license and starting to professionalize the industry. That's a rich history, the CLCA, and what they did for our industry back in the 70s and 80s. And if you ever go to the headquarters, I'm sure you've been there, right? Everyone's pictures on the wall and in their suit and ties and everything. That's pretty awesome.
Yeah, So then kind of, if we fast forward, my dad always told me to go get an education. So I didn't like school, right? And so reading, mathematics was pretty easy for me, but sitting down and reading a long book was just very stressful for me. And so I went ahead and pursued a college degree. So first in the family to get one, 4-year degree from a Cal State university here in California. And so felt pretty proud about that, and then said, Dad, I'm not going into the landscape business. See you later.
I'm out.
I'm going to do something in professional services. And so I went into a couple-year stint working in professional services, and my dad kept coming to me, and that was around the time of the roll-up in the late 90s, and said, hey, do you want to be part of the business? And I said, I don't know. And so he said, well, let me show you what I have. And so he's all, I've got this great little business. I've got systems. I've got processes. I've got software that's helping me run our business. And most importantly, Chris, I got this really great team that's loyal to our clients and loyal to us, and that has been very good to us. I want to get you exposed to it. So in 1999, I said, Dad, you know what? I'll come help in the family business. And we were doing about just under $2 million in annualized revenue at that time. 50% of our book of business was residential. So we're talking about front yards, backyards. And then in Southern California at that time, where we grew up and worked, most of where our routes were, Hollywood was a really big industry. So we were servicing large estates, per se, that you would consider today a small commercial monthly or annual account. And so that's where I started. And I learned a lot working on routes, on residential routes with crews and clients, because the demand side from a residence that's in a state is far greater than you could experience it in any commercial relationship. And so that really set the stage in our business, our culture, from a hospitality perspective to really service our clients. And so that elevated our game. That helped us stay focused on the high bar of 95% client retention rate year over year, so that we didn't have to go win back a bunch of business every year. And so that's kind of how I started in the business back in the early 2000s, late 1990s.
Wow. And so with that customer base being high-end residential, it must, like you're saying, it instilled these work ethic levels and this customer satisfaction and experience, I'm sure, that you guys had to step up on. How much do you remember, like, when you were doing that, how much of that was driven by the customer, that the customer was saying, hey, I need you to do this, I need you to do that, and you guys were kind of reacting to those demands? Or did your dad already have kind of the system dialed in that you got to kind of step into? How much of it was kind of that reaction to client demands versus what your dad had already built in that early 2000 era?
Yeah, so the client definitely helped us be a better organization. Company. And so having really good clients with high demands and high standards really helped us elevate. And so instead of running from those challenges, we ran toward them and learned from those. And so, the whole innovation of different chemical products that would come around. Plant healthcare, the whole reason we got into plant healthcare is because we had very technical gardens on residential estates that needed different care than just a cheap fertility program. And so that's what challenged us to become arborists and then start a tree division. That challenged us to open up a plant healthcare service line where we're going out and diagnosing and treating very high value landscape assets. And then just to get smarter, wiser about water. And so, but what I haven't told you, Justin, is just a few years after I got involved I had a grand idea to sell off all the residential accounts and just go commercial.
That's a crazy bet. Tell us about that.
Yeah, so after learning from these high touch, high demand clients, it didn't make sense to me to have a route business and try to scale the business with the demands, because the ratio of managers, which we were calling managers at the time, now in the industry we call them account managers, you had to have a very tight ratio of maybe 30 to 40 jobs per account manager. And then when those were all residentials, those really started to stretch out our management team, and me being one of them. And so I realized that I could spend this, I could have a lot more time working those same number of commercial accounts and then start growing the business. And so the allure or attractiveness of growing the business was taking great people that were working around us and with us and giving them the opportunity to promote within. And so that's what really was the catalyst or driver of growth. And so it wasn't that we needed to grow for a particular reason, but our people wanted more opportunities. And if I didn't provide it to them, they would go somewhere else.
Yeah, I know the type, right? The growth mindset. Those are the people that we seek out when we're interviewing and trying to find the best team members. But, it's a double-edged sword. If you don't grow the company, then and give them opportunities to advance, they're gonna go find a place that they can grow that doesn't have a ceiling. So it sounds like the demands from the clients and the core team you guys had really ended up becoming a driving factor in your growth. When did you guys decide to go all in on commercial? And is that the point where things started to pick up in terms of growth every year? Or when did you guys really start this hockey curve, hockey stick type growth in the mid or whenever it happened in mid 2000s? Yeah.
So that's an interesting graph. So I'm visualizing the benchmarks, right? From 1 million to 5 million, 5 million to 10 million, 10 million to 15. And so when you look at it at $5 million chunks, right, which we consider in our business now a branch, 5 to 7 million is what we consider a branch, where we can afford a branch manager, account manager, and a production manager, and then we really see optimization at 10 million for those branches now in Southern California, particularly because the cost of real estate in California is so great. And so I've got great peers of landscape guys across the country, and when I go to their yard and I see they have 6 acres and they're utilizing an acre of it very inefficiently, I'm like, wow, I could never do that. I'm putting $10 million in an acre if I'm lucky, right? And sometimes it's a little smaller than that. So that's always interesting. But we as soon as I'd say it was 2000, we transferred out of the residential business because we were our close rate of winning new business on the commercial side was really great. And particularly, it was homeowners associations that were being installed by developers and sometimes master plan community developers. And then we would just have the opportunity. We worked with one master plan developer, and we just started getting all of their referral work. And we would just price it the way that we do to price it. It felt very easy for us to grow. And so I'd say from 2000 to 2007, we were 30% annual growth rate on top of each year. And so we really scaled pretty fast right before we saw the 2008 recession with the housing market. And so that slowed us down to, we were still positive growth year over year for 3 years after 2008, but we definitely slowed below double digits to single digits. And so what's really interesting for our audience to know is growing up in Southern California from 1970, I was born in 1973, so when my dad started business in 1970, all the way to 1999 before I got involved in the business, we had a single household earning income from $0 to $2 million providing the opportunity to send 4 of us kids to private school, private Catholic school, and for us to go on a 1-year annual family vacation. And so it's definitely was the best rewarding time to grow up in Southern California, what I'd say was the 70s and 80s. And so I certainly do miss that feel. It was a lot easier than it is today. So now we've got dual income, and there's a lot more costs and expenses and regulations we're dealing with. But back to the growth chart. And so hockey stick accelerated between 2000 and 2007. And I think at that time we got up to about 10 million in those seven years period. And what was beautiful about that is we were retaining the work too. We didn't have to go out and go capture the rework. And so that was a big discipline that my dad instilled in me and in our organization was, the client first and always keep your client through a hospitality approach of the level of servicing them. And so that was great. And so after the housing market, we collapsed, we then inched up to 15 million and got to about 17 million. And that felt like it took the same period of time of the first hockey stick. And then we kind of just sat for a while. And so we had these growth spurts of double digits and then single digit growth for the next few years. And then we'd get growth rate again. And what I learned was that was somewhat generated or morphosized by us because we were growing as an organization. We didn't know, right? So we had systems and processes to run 5 million, and then we had to go figure out how to build systems and processes and org chart to run 10 million and then 15 million and then 20 million. So you get stuck. And so most guys that I socialize with in our industry do feel that ceiling, and it used to be 5 million. And so now I think it's 10 million, right? That a lot of guys feel. And how do I do that? And so there's big risk reward in the scaling aspect of it because you're bringing on someone that's making the same amount as you and you're holding all the equity eggs, right? And so you're like, wow, this, and then you've got, a wife and a bride that says, hey, I want to make sure, that our family's taken care of too at the same level as your non-partner partner that you brought into the business. And so there is definitely scaling to a regional level. There is a lot of emotional elements to unpack at home and then in the business.
Absolutely. Totally agree with that. And it's how'd you make the decision when you were faced with that decision of bringing on someone that was going to theoretically lower your profitability and maybe even lower your ability to take money off the table every week or every year? What was that decision-making process? Was it that you had a vision of you're going to grow this thing really big, or it was the next thing you knew you had to do when you were faced with that $5 or $10 million ceiling? How'd you make that decision? How'd you come to that final decision? Okay, I'm gonna hire the next level.
Yeah, so I think bigger's not always better, and I'll get to that later in our show and talk about how we've been really refining our margins and slowing down our accelerated growth, but then really fine tuning our gross margins and our net operating income. But when you're younger, you want to help provide solutions to your specific type of client everywhere they're at. And so, and then you surround yourself around like-minded people that want to do the same thing and complement you by your expansion desires. And so, to me, I didn't worry, and my dad, when we were partnering in this, we didn't really worry about splitting salaries to bring good people in. We were always of the attitude that let's hire someone smarter than us that's done it before and that can help partner with us and teach us. And so we weren't intimidated or felt inferior by good top talent. And so I think that really helped us scale faster than maybe some other organizations have had the ability to. And so, the journey's been great. And the most important aspect is understanding the different type of people and personalities and really having the willingness to listen. And so that always hasn't been easy when you feel, because as you mature, you reflect back and go, oh man, I wish I didn't lose that team member, right? I want that team member back. But, I've certainly had some great team members in our organization that are no longer with us that I wish were still with us because of my lack of leadership at the stage we were at. Yeah.
That's interesting. I mean, do you feel like you've done the opposite as well, where you've held on to people maybe a little too long too?
Yeah. So, when you think about field versus management or leadership, you look at it both ways. So we still have, I think our last team member that is nearly 50 years with us. And so he just retired out this past year at 76. And so we have several dozen 20-year team members, that are in the field level, that are great and loyal, that have moved around. And then, we've got, 50 plus 50s to 100 of people that are 5-year plus tenured people. So our employee retention and our tenure has been great. I had team members that have been in our business a little bit too long? I think not that many. I'm sure that there is one or two that I can particularly think of, but we've got a close to a 500 team organization, and so yeah, so no regrets on not letting anybody go faster.
Nice. I mean, that's when you're growing and adding that many people, and you're able to retain that high level, that amount of people that long. I mean, that says a lot about your leadership. And when it came down to the journey, at what point was there a handover from your dad to you? And it was, all right, Chris is now in charge. He's the president, CEO, whatever the title was at the time. When was that? When did that happen? And was it a transition? Was it an event? Tell us a little bit about that. I think a lot of people struggle with that.
Yeah, they do. And so I don't think that we had a great roadmap for that transition. And so I think it was interesting. If I reflect back, and I'd love to, I think that's a great question to ponder with my dad, who's been retired for a few years. But in 2012, so about 13 years after I got involved in the business, was when I became the president and CEO of the business at that time. And so my dad enjoyed doing things that he wanted to do, and the business side of the business, he wanted to delegate that. And so that's kind of how he transferred those authorities over to me, so that he could continue to do the things that was really passionate for him, and that was account management and production management type work, right? And so watching, observing crews work and dispatch and high-fiving them in the morning huddle, and then, taking client challenges on and creating solutions for clients. And so building back offices or building systems and processes, or scaling up from a sales side on delivering, a proposal with a great sales message for a large client wasn't something that interested him. And so but it interested me. So it was easy to say, okay, Chris, Perfect. You do this. I'm going to do this. This is where I'm going to stay in this lane. So 2012 is when we transitioned. My dad transitioned out of our business, I'd say, in the late 2000 teens, early 2020s. No, I think he was out before COVID. So I'd say probably 18, 19 is when my dad said, hey, I really want to just step away from the business and just operate as a board of director capacity. And so that's where we are today as partners in our business.
That's very similar story to me and my dad. And it's interesting. My dad started K&D in 1986, and he enjoys the same things today. He enjoys solving problems. We're like, he's like the in-house engineer, and he enjoys the operational side and seeing the crews on the job site, not so much the back office systems and process and software and all that other, BS that we got to deal with. And it's I think builds the best team in the industry is when you have a founder that is available to go and meet with a client when they're unhappy, or to deal with a very complicated drainage issue, or to sit down with a team member that maybe is a little upset, who's been there for 25, 30, maybe 50 years in your case. And to have that support today on the board for you, but also, 10 years ago, to have that support day to day. I mean, for me, it's huge. How big of an impact was that for you to know that he had your back when you were making some of the bigger bets and starting to really grow beyond that 20, 30 million mark?
It feels really good, for sure. And so it's the ideal father-son relationship journey that you desire to have for your son. And so, yet I grew up in a family that was a strict Catholic family. We're from Italian roots and strict Catholic. That's what drives most of the values and behaviors in our business. It flowed out of, how we grew up and were raised in our home, and we carried on those values into our business. And so it feels really good to have support when you're in a family business from other family members.
Oh, it's huge. It's huge.
Yeah.
And so I want to ask this question, because this is a question that I get a lot from our listeners, is they're growing a business, whether it's 3, 5, 10 million, wherever they're at in their journey, and they're facing that decision that, hey, I've gotten as big as I really can in the market I'm in, and I need to open that next branch. I need to geographically expand because I'm not growing any longer. When did you guys hit that point, and when did it happen? When did it make sense for you guys to open up and go from a headquarters to multiple branches? And did you do it all at once? Did you go from one headquarters to 3 branches, or was it one at a time? Maybe walk us through that a little bit. I think that's a question that I know I get a lot.
Yeah, so interesting. So we were a one branch company up until the 90s. And so operated our office and our dispatch out of the same location in a small yard in a city called North Hollywood, California, just on the other side of the Hollywood sign. And so we had a client that was 20 miles north of that location ask us to come out and do 3 of their commercial buildings. That client was a master plan developer that ended up building out North Los Angeles by way of building out retail product, apartment product, and then housing, which consists of HOA. And so, yet we did not bid any of the installation work. We were their primary vendor for picking up the landscape maintenance work, the reoccurring work. And so what they found is that the companies installing their work didn't understand the concept of maintaining it post-installation. And so we were fortunate to pick that up. So that's when we opened up a second location. And so we had 2 locations for 30 years of our existence. 35 years.
Okay.
And then as we started to scale and really build out those 2 locations, we were having problem finding talent to come work for us because we were kind of running our office, our back office, and our leadership team out of a garage next to the mechanic shop. So, so when we brought people on, they're like, whoa, I would like to see a more professional environment. And so that's when we bought a freestanding office building where we could house our administrative team, and my dad and I had an office. And so from there, we had clients that brought us into other markets, and our goal is to find an anchor job before we would establish a branch. And so when I say an anchor job, that's something that is around $1 million in annual, and then from there we could share the cost of a manager or leader driving from market to market until we added on more business. And so I'm really hesitant to go into a new market and then just try to, grind it out from the sales approach. I'm more of a fan of having clients bring you into those new markets, and then you're really successful.
Yeah, the on-ramp to where you want to be of, let's say, $5 million of annual revenue for that branch becomes, much more attainable if you have a large client pulling you into that market. And what's your tip? So let's say it's a $5 million branch is kind of your ideal, and you're launching when you have an anchor client, so to speak, $1 million of annual. And where do you guys like to sit when it comes to the additional work, the enhancements, water management, tree work? Is it, if you get $1 million in recurring revenue, are you shooting for somewhere around 500,000? What's kind of the standard that you guys shoot for?
Yeah, so I get a lot of exposure from benchmarking in the industry across the country on what that looks like. And so in Southern California, we've had different experiences with that. And so we've consistently been at the 40%, so 40 cents on every dollar, which would include tree care, water management, landscape enhancements, and plant health care. So of course, we've got some branches that get to 50%, but we've never been a dollar for dollar ancillary service on our base maintenance contract in Southern California. We also, it's important to recognize, we don't do landscape installation work, and so we're doing truly just enhancement work on pre-existing landscapes.
Yeah, I think the benchmarks can get a little fuzzy when people put their numbers in, and enhancements tend to roll in a few extra jobs that aren't really in the book of business. But I see the same numbers where we're at up here. Getting to 50% is kind of tough. And when you're maintaining newly installed landscapes or a new community, I mean, for the first few years, there really isn't a whole lot to do in terms of enhancements. So that's where we found ourselves in tough spots, where we've taken over a brand new community. And I mean, there really shouldn't be much to do. And in the first year, it's probably going to be warranty work anyway. So, it's an interesting model. How have you guys, and you specifically as a leader of Stay Green, how have you stayed so disciplined in regards to maintenance and not gone in after the construction? Because it seems to get just about everyone, even people who say, we're going to only be a maintenance company. You talk to them 3 or 4 years later and they're doing, 20, 30% construction. What's been the secret to that? Or is it just straight up discipline? You have a vision and you're sticking to it.
Well, my dad was very disciplined at just sticking with maintenance. And so obviously, not obviously, but I had a desire to get into the installation. I said, I could probably master that. And so, when the transition of responsibility shifted, I think it was probably 2015, I did enter the construction business. And so we ran, I'd say for 3 years, we did about $3 million of construction on our, I think at the time, 17 to 20 total million of revenue. And it was how we estimated the job was never how we completed the job and the actual results. And the amount of AR babysitting or managing, trying to collect your cash was just so exhausting. And so I think what really put the nail in the coffin for my short stint of experiencing landscape installation was waiting about 9 months to get paid on a $1.2 million install for a builder on a retail center, shopping center. And I think out of that $1.2 million, they were holding $900,000 for about 9 months. And so carrying that cost when you're, a cash intense business, cash flow is important and king, was just the stress and what keeps you up at night. Was that for the better half of a year? It certainly teaches you well to get out of that sandbox and do what you know best.
That's such a great experience, Sharon. It happens to us all the time. I mean, we were just talking today, literally in the office, about a GC that owes us a bunch of money. And I just, I'm like, we got to get off of this construction, thing. Because the more we go into maintenance, the more our business growth starts to level out. And I don't mean level out like we're not growing, but like it just steady. And if you retain the clients you have, you don't have to go and sell. Let's say you're doing $10 million a year. You don't have to sell $10 million every year to just keep the business going. You retain 95%. Well, you only need to sell, $1 million or $2 million to get 10% growth. So I really just commend you guys for the model, for sticking to it, for testing it out, coming back, because in today's world of private equity, everybody is now focused on commercial maintenance. And that leads me to really my next question is, being in such a large market of Southern California, how's the private equity consolidation impacted your business and your ability to grow? Positive, negative, neutral? What's your kind of experience on that so far?
Yeah, so from going out to sell, it hasn't really impacted us on the sales side of the business to go sell and win new work. It's actually, from a pricing perspective, made the business climate a bit healthier because of the demands on the return that PE wants from the business they bought. So you're not going out there and pricing work below market just to capture market share, which has been healthier for us. And so that's where we've been able to see margin expansion as opposed to contraction. And so we do like that. But competing per se in the space with private equity, it's professionalized the industry certainly more, right? From our perspective. And so you do have sharper branch managers, account managers, because the data, the numbers they're expected to know and how they got there is important to those back offices. So I think talent has risen, and they've professionalized the industry a bit more than how it was perceived by consumers. So I think it's been good in some sense. We have intentionally stayed away from the temptation because we enjoy our family company, and we like the legacy journey we're currently on. It certainly can create wealth for people that want to be able to pull and liquidate their balance sheets, and so it's good for those individuals that choose that path. And so, fortunately, I'm young and I've got a family that's interested behind me, so we've kind of been staying away and just staying disciplined to our legacy family growth in our company.
Yeah, man. I feel like I'm in the same boat as you, and we get the calls every day, and it is tempting just to think about some of the numbers that they're throwing out there and what you could theoretically walk with. But what you said about being able to control it, having the family legacy, there is a certain amount of power, and it feels good saying no. And every time you say no and keep the family and the equity within the family, it's almost like you're doubling down on what you've built. And I think the employees see that, and they see everybody around us selling, and they look and they go, okay, like this is actually a really good place to be, because I could leave maybe for a higher paycheck or, a little bigger of a bonus on signing, but where is that company going, and am I going to have a new boss every 3 years? And I think there's a lot of value that comes to staying as a family business in today's climate. So you mentioned earlier about tightening margins and increasing margins, should I say, improving gross margins, improving net margins as your focus maybe in the last year or two. Tell us a little bit more about that. What's the shift? Why the shift? And what are you doing to increase those margins?
So couple of things that we've been disciplined with is, so annual client reviews are key. So you mentioned, right, retain the client, sell more work, but then also, client reviews to keep your margins where you want to keep them when you originally bid the job 3-6 years ago. And so it requires you for those cost of living increases. And so over the last 5 years, we've saw some significant wage inflation. And I think there were a lot of team members in our organization that were afraid to ask their clients for the increase to keep them right where their margins were. And so we were just pretty disciplined on going one by one to make sure that might be 5%, that may be 3%, that client may need a 7%. We'd have those discussions. And of course, with the intention of wanting to keep retain the clients. And so we did it very tactfully. And so that's been one key element of keeping margins where you want to keep them is your annual renewals with your pricing increases. And then software technology and these applications have just gotten really smart. So telematics in your vehicles, routing software, so you can really see like where you're wasting time and how much windshield time you're spending. And so constantly looking at the opportunities to create efficiencies in routes and reduce windshield time. And so that's always reviewed, typically quarterly that we're reviewing that. And then when you start a job and you've been on that job and you've been job sequencing and working that route and for, more than a season, you create efficiencies there. And so we challenge hours. So when we look at estimated hours to actual and we're only using less than estimated, we just readjust on that for our next year so that we're not those hours are no longer available when it makes sense. And that's really helped us with the margin expansion.
I mean, that's a double, you're doing two levers at once headed in the right direction, increasing your price and decreasing your cost. And if you're getting efficiencies with routing, then that's a third lever. Now, as gross profit is increasing, we know you mentioned wage inflation. We've seen that obviously with the overhead side as well, whether it be your back office or account managers and branch managers. Have you guys been stabilizing your overhead to make sure that net margin isn't eroding?
Yeah. So, there's some really good industry benchmarks on where you want your indirect salaries to be. And so you can choose to grow those if you're going to be aggressive with your expansion. And so you just make sure you're disciplined to what that timeline is. And so, sure, we run hot in some branches, but it's with intention. And there's others we're really lean and efficient, and their contribution margin's very good. So you just have to be intentional about it and understand where you want that number to be, because it all starts with pricing right? So you have the right gross margin, and then your indirects follow. Particularly, I mean, you and I know if you go out for a piece of real estate now and you got to lease that for your branch, you know what that's going to cost and what percentage that's going to hit your P&L for that location. And you're like, wow. Like, so you've got to put revenue in that branch to reduce that percentage on your rents. It's not like that in other parts of the country.
No, man. I mean, we're squeezing. We've got like a third of an acre branch, that we've got like 10 trucks that we squeeze in every night. I mean, there's just not a lot of real estate to be had out there right now, and it's expensive. in California especially. So Chris, you've shared so much with us. I appreciate you being so open here, and you've scaled, just so the audience knows, you've scaled to what, 9-10 branches now?
Yeah, so I think we're dispatching out of 10 locations. Our most unique one is on an island 26 miles off the coast of Southern California, which is great. So we service a resort owner out there that it's really fun to go out there. And so I have the opportunity, I either take the boat out with the guys or a helicopter over there with a chartered helicopter to go visit and do site inspections. And so 10 locations we're dispatching out of. There may be 2 additional, so there might be 12, which we would consider like satellite locations, which they don't have infrastructure per se as far as a full org chart of account manager, branch manager, production manager. They're just teams dispatching out of a place because it makes sense geographically, and then overseen by a primary branch, which is the closest adjacent to it. But yeah, about 10 to 12 locations currently.
Yeah, that's incredible. And have you guys done any acquisitions yet, or is this all organic so far?
Yeah, so we've done 4 acquisitions in our company history. The first one was just over $2 million in revenue, contract revenue, and that took place in 2010, about 2010. And so, fortunately, we have over 60% of those clients today, which is neat. And
that's good.
I would say 70% of the team members that came over as well. So that's been great. So from a success criteria, I'd say it's been very successful, that one. And then we did one just before COVID, which was just under $7 million in revenue that got us into a new market. And so we were operating 2 to 3 routes, low revenue, in a market where we didn't have much saturation. That was about 40 miles from the closest branch. And so this acquisition made sense to go in and lever up and buy some contracts so that we can really grow that. And then it's been one of our fastest growing locations year to date. They grew just under 50% year over year on their contract revenue. Out of the 10 locations, they were the fastest growing in Orange County. And then we're still looking. And so the fit, what's important to me is the people. And so it's the people. It's got to obviously be the right type of client mix, but it's really the talent, the people there, because it's extremely hard in California to recruit and retain and find good people. So most good team members and players that want to start families realize that it's a lot less expensive on the other side of the state line in Arizona or Nevada. And so that's where a lot of the exodus has been from top leadership talent and landscape in California.
Especially that top level talent, because they can go and get paid pretty similar wages in Phoenix or Las Vegas, and have a whole different cost of living structure. So we were just talking about that today, actually, it's almost impossible to recruit people into California because of the cost of living versus what we can pay them. It's just like they can make so much more in other places, or at least like comparatively to the cost of living in those areas. But they don't get to take a helicopter to go visit their sites. So that's a
for
plus.
Sure.
Oh man, well, this has been an awesome conversation. I mean, the story of Stay Green, what you guys have done, how you've built it kind of brick by brick over the years is incredibly impressive, and you guys have a reputation that follows that. So I just want to thank you for coming on the show and sharing so much. And we always end the show with a little bit of a trade secret, kind of something that you've learned over the years, something that you fall back on. Maybe it's a quote or something that you that comes to mind when I say this. But do you have anything to share with us here as a trade secret?
Well, yeah. So I pondered that, and so I think it goes down to culture. And so culture really sets your organization apart, right? And when you're competing in the marketplace. And so we built our business around a core set of values. And when you're working with multinational team members from different countries in your business, the value may not translate as well as the behavior or the action. And so my trade secret is manage the behaviors and talk about the actions that really align with the value that you're trying to achieve. And so values, behaviors, actions really line up. And so watch the action.
Couldn't agree with you more. We had a funny one with that where it was like respect means different things to different people. And you know, you ask 5 different people to define respect, and you're going to get 5 different behaviors. That is a great trade secret, and something that we're still trying to learn and figure out, because the behaviors are everything, and sometimes the definition of those behaviors in the English or Spanish language is very, very different. So great share there. Thank you.
Yep. Thanks, Justin.
Chris,
appreciate being on.
It's been great having you on, brother. Thank you so much for sharing. I'm sure I'll see you around the conference circuit this year, and we'll cross paths and have to keep catching up. But congratulations on your success, and hopefully the generation continues, or the third generation here. Sounds like you got some kids that are interested in taking over, so hopefully that goes well.
Appreciate it.
All right.
Thanks for tuning in to Trades Talk, where the next generation of disruptors comes to raise the bar. If you got value from today's episode, share it with someone in the trades who's ready to level up. For more tools, insights, and community, follow host Justin White and join the movement at jwhitegroup.com.